In today's video, we are going to look at a split study and heavily analyze the one-year term rider to see if it makes sense if you're looking at a whole life insurance policy that is designed for maximum cash value. We have a lot of fun talking about this stuff. So let's get on into it. What we are going to look at specifically in today's case study is as follows. In our last video, we went through an overview of the one-year term rider. We are going to look at an example with Guardian that we touched on very briefly in our last video, but we will take a look at Guardian, one of our four major mutual companies. And specifically, we're going to look at the same policy with the same company, same individual. You'll see a 40-year-old male. This will be a 7-pay. What that means is we're going to max fund the policy for 7 years and then nothing thereafter. Look at a reduced paid up option. And we're going to look at these different splits. So different splits. We've got a 1090 split. What that is a 10% base premium. So he has a total of $100,000 per year going into the policy. So he's got $100K going in. What a 1090 represents is that 10% of his base premium, 10% of his total payment, the 100K, which would be 10K, is directed toward his base premium. Premium dollars, what happens with premium dollars? They do not show up in cash value in the first year. With the particular product we're looking at, you will see right around 15% of the premium show up in cash value immediately. A little bit more than that, but the biggest bite of our payment that does not show up in cash value is the premium. So the question is, do I add a one-year term rider so I can open up more flexibility? Because with Guardian, if you have a one-year term rider, you can 10x the base premium in PUAs. If you do not have a one-year term rider, how much can you add in the PUAs? Not 10x. The maximum is 3x on top of the base premium, which means you would need a minimum premium of $25,000 because you can add an additional 3x, 75K, then 25K in base plus 75K in PUAs gives you a total of $100,000. So what we're going to look at here is not 25%, rather 30%, so a 30-70 split. We do need a term insurance rider attached in that example in order to prevent a MEC from occurring. So we're going to look at a level term rider. This is sometimes requested with folks we work with. So we're going to see what it looks like here with a one-year term rider compared to a level term rider. And then a follow-up question we sometimes get is, what does it look like with no term rider at all? 60% of my payment directed toward base premium. So $60,000. Keep in mind as well, whatever your base premium is, that is the dollar amount that you are committed to. So if you like the idea of having a minimum premium policy where you can commit to the minimum and throw in additional funds at your discretion, a one-year term rider does help, particularly in this case where we've got Guardian, one of the major mutuals that offers a lot of PUA flexibility. And then we will also look at the guaranteed and non-guaranteed values. The guarantees will be really interesting to see because we get to see worst case scenario with respect to expenses and everything associated with the policy. All right, let's get on into it. So we've got our comparison sheet, but before we do that, let's provide some transparency here as far as the actual illustrations, which we pulled all of the data from and threw them on Excel. It's just difficult to go through the illustrations one by one at a time. So I'm going to reference the main points so you can see the design, term rider cost, all that fun stuff. 100K per year going in for 7 years. Nothing thereafter. You'll actually see on this illustration, a reduced paid up was exercised at the beginning of year 8, which killed the premium altogether. This is a 15-pay policy, which allows one to make premium payments for a maximum of 15 years. Now, here's your base premium, just under $9,100. Then you'll see this figure is almost exactly 10x your base premium. Look what that is. Paid up additions rider. So if you want to know how to build the watch here, how to construct the policy for maximum cash value, or if you're looking at a policy, what do I look for to make sure my expenses are minimized? This is as aggressive as we can go with this Guardian illustration, with the exception of the first year. You've got that 50x rule where you can really heavily fund a policy. We've got other content on that though. But maximum we can go each year. If a 1-year term rider was not attached, we could only pay an additional 3x per year into PUAs, just to reemphasize that point. So the 1-year term rider here, what it does is open up the window so you can add more money into the policy. Now, as you're pumping money into the policy, what happens with PUA payments? We all think cash value because it does accelerate our cash value growth. So this column represents PUA deposits and what shows up net of all fees and everything from PUA deposits in cash value. This column represents the cash value buildup from PUA payments over time. It excludes base premium dollars, as base premium dollars do build cash value. It's just PUA deposits and dividends that are added. The column immediately to the right, total face amount of adds. This represents the additional whole life death benefit that is purchased from your PUA payment. Now what happens again with a 1-year term rider? If you saw our last video, whole life goes up, as we see here. Term comes down. The whole life plus the term life will always equate to the initial death benefit we designed the policy to have, $2.1 million, which gave him just over a $100,000 MEC limit. What that means is he said, I'm interested in cash value. I want the minimum death benefit possible. I want to be able to pay $100K in based on a 40-year-old male with this product. This gave him a MEC limit of $100K, just a little bit more actually, but no MEC, guaranteed and non-guaranteed. So that term rider comes down. We see the cost in the first year right here. So OYT, 1-year term, there's your cost in the first year. However, Guardian does not disclose the actual dollar amount of the term rider cost each year after the first year. How we get it is this guy. They give how much a term rider costs for every $1,000 of term. This is for a 40-year-old male. So what this means here, we see in the first year, whatever my term death benefit is, it's 40 cents per 1,000. So you can multiply that number by 40 cents and you'll come up with the $628.09. But then you've got to do that each year thereafter. So what we do is calculate on a guaranteed and non-guaranteed basis, because we've got the guaranteed costs there, exactly what that will look like. So here we go. We drop it onto Excel. First year will always match dollar for dollar, so you know you've got your formula right. There's the term rider decreasing. You'll notice over here, look at the guarantees. When we get to this piece, the term rider, based on the guarantees, decreases at a slower pace, which means naturally the costs will be a little bit higher too. Why it decreases at a slower pace is when dividends are paid to your policy, which this illustration, based on the current dividend rate, reflects. Those are reinvested into paid up additions, which give us cash value, but they also give us more death benefit. And as your whole life death benefit comes up, your term death benefit comes down. It's like some complex math formula, right? With all these things. Point is, very easy to simplify. And if you want the simple version, we just want to look at the cash value, the net cash value at the end of the day. But let's go back to that illustration. So this was the term cost breakdown. If we go back to the ledger statement, we see the actual cash value over time. Okay, looks good. I almost forgot to mention something very important. This particular illustration, if you're comparing numbers to the guaranteed and non-guaranteed values, look at this. So we actually ran this example with no dividends ever paid. So we kicked the dividend rate to nothing, 2%. The guaranteed rate here is 3%. So it assumes only the guaranteed rate of 3% is credited and you won't see any dividends. So these values will match up with the guaranteed illustration that we have. And you'll see the non-guaranteed illustration as well. In fact, look at your break even here. Here it's years 8 to 9. If we go up here, you'll see a different story based on the current values, your current dividend rate, as it should be between years 4 and 5. All right. So that's the 1090. Then we did the same thing with the 30/70 and 60/40. Different story. We don't have to calculate the term costs here because we're not using a one-year term rider, but we've got a 30% base premium, 30% of the total desired payment. Term rider cost, PUA. RTR, renewable term rider for 10 years. It is a level term. There we go. And this is also based on the guaranteed rate Guardian did when we ran the guaranteed rate. It was a little bit of a dividend. Zeros all other years, but that really matters. The $340, it makes the guaranteed values look a little bit better on the high base premium example. And then we've got the same thing, and this is the current dividend illustration here. In fact, let me go back to the current values in case you like to cross-reference the values from the illustration with the Excel comparison sheet. So the current values here, based on the current dividend rate, there we go. Between year 6 and 7, what was the 1090? Between 4 and 5. So we see a difference there already. Now, what do we notice here? This is the 60/40. Because it's a 15-pay policy, we actually needed a 63% base premium. If we looked at a longer funding policy, you'll see that when we look at our Mass Mutual segments, when we've got policies that can be paid until age 100, you'll notice the longer you can pay into a policy, the base premium will get you a higher death benefit. So if we took this $63,000 base premium with a traditional product where you can make payments until 100 or 121, instead of getting you 1.9, it'll get you closer to, call it 2.9 or even 3.5 if it's a whole life 121 policy. Much more death benefit, which results in more mech space, and you can plow more money into PUAs. And we could lower it. But in this case, we wanted to keep things all equal with that 15-pay policy. We were aiming for a 60/40, close enough in this example. It's not going to make a difference. It's really not. All right. So here we go, 100K per year for 7 years. There's the big difference. When you go, regardless of the product type, when you go with a higher base premium, you're going to see less cash value up front. You're going to see a delayed break-even point, and you're going to have a higher commitment. The big thing is, in my opinion, if life happens and I can't pay the premium, what's going to occur? That premium has to be paid from somewhere. If I've got a high base premium, a premium offset where the dividends and interest cover that base premium might not work. Depends how much cash value I've got in the contract or in my policy. I could do an automatic premium loan, but that's a large loan just to cover the base premium. I'm a huge fan of having a minimum premium in the event life happens, but then still treating the policy as if I had a large policy, because then I'm plowing more money into PUAs, gives you more value at the end of the day, and then I have that flexibility in the event things happen. If a recession occurs, that benefits a lot of people because high base premiums, when I can't pay anything, become stressful. So how do we remain stress-free is the big question. So to get back on track here, no term rider attached here, just base and PUAs. So let's look at the comparison. This will be way easier than going back and forth. And the first piece we had, this just displayed the term costs with the 1090 design, which is actually a little bit less than 1090. It's closer to a 991. But you see the 1-year term cost based on the current price and then the guaranteed maximum. And we also assumed here, not just the guaranteed maximum charge with the current dividend rate, but with the guaranteed rate as well. So this way we can see higher cost along with a low crediting rate, or no dividend, I should say. So let's take a look here. We'll look at the current first. What do we see here? On the left, we've got minimum premium. 9,000 and change. There's your term cost. What this individual, if this is you, a 40-year-old individual wanting to pay in 100K per year, what you would be committed to in this particular example would be the premium cost plus the term cost. We want to round up, call it 10K per year. Just about that. If we're not funding PUAs in the beginning, it might be a touch over $10,000, but you've got a minimal commitment, just the base and the term cost and the ability to pour everything else into the policy. Remember, Guardian gives you a lot of flexibility, so you can pour it all in at discretion if you want that. Some people prefer to pay it in all at once. So here's your cash value. Crossover point, year 5. What I mean, you've got more money than what you paid in. What I also want to hit on here, look at year 1. You're paying $100,000. You've got just about $85,000. Year 2, I pay in $100 again. It grows from $84 to $182. If it was a 0% bank account, or if I stuffed it under my mattress, it would grow from $84 to $184. I got less back than what I paid in. So first year, little less than 15%, little more than 15% of that base premium comes back. I still have the term rider cost. The PUA fees is really why I'm seeing it negative in the first 2 years. Then by the time I hit year 3, 182 to 284 when I paid in $100K. So I gave the insurance company $100,000. I saw the cash value actually grow by that $100,000, and then I received in dividends and interest just over $2,000. So the net growth that particular year was about $2,000. Next year, closer to $6,000. I pay in $100, grows from $284. I get that back to $384 plus another $6,000. I'm at the $391, or about $7,000. I'm sorry if I could do math this afternoon. Still feels like the morning. But there we go. Funded for 7 years. Nothing thereafter. 30/70. Biggest difference. Here's what people are going to look at, or what they do look at from experience. Corporations, individuals, myself. 85 with the 1090, same company and product, under 70,000 with that 30/70. So there is a individual, there's a lot of people, but an individual I really like his perspective. He's very, very good when it comes to business. When we first looked at cash value life insurance, and he was shown different proposals and was told, hey, it's okay to take less upfront because you'll have more long-term. He might have been told you should have more long-term. I'm not sure. I wasn't in that meeting with the other agent. But he looked at it and said, no, how I grew my business is with capital. I like the idea of having cash value up front. To him, this was a great idea to position funds better than a bank account, actually sees it grow. The tax benefit is nice as well. It appreciates over time. But was by no means worth taking a huge hit up front. He's like, why would I do this? No. The reason why, opportunity cost. What are the core benefits to a cash value life insurance policy? Safe, liquid, tax-free. The net growth rate will fall somewhere between 3 to 5% at the end of the day. Net, that's what it'll do if it's designed properly with one of the major mutuals. We've got our historical performance to validate that. But to take less up front, where now I give up $30,000, if an opportunity comes that I don't have that money, it's not there. If an opportunity comes and I cannot take advantage of it, that is the pain point so many people experience and why they do not start whole life insurance policies. We've heard it time and time again. And I get it, I'm with them. So here we go. Also, what do we notice here? Break even between years 6 and 7. You see a similar pattern. Year 2 was 69. You paid in 100. It grew from 69 to 165. That means you got less back than what you paid in. If you got the full 100K back, it would grow to 169. Finally, by year 3, the end of year 3, when dividends are paid, I get more back than what I paid in that year. But it takes 7 years before I actually see appreciation on my cash value. Take note of the death benefits as well. Right off the bat, are they different? Very, very similar, because the individual wants to see an apples to apples comparison. 100K MEC limit, 100K per year going in, same company, same product, everything, provide transparency. Here we go. Now, if we look a ways down the road, what do we notice here? Is there a difference in value? Yes, big difference. How about the last guy, the 60/40? 100K per year going in. Right off the bat, $45,000 in cash value. Positive based on the non-guarantees in year 8. Year 20, 1.309. Let's look at year 30, 1965. 3070, 2 million and change, almost 07. And then what do you have over here? Look at this, close to 2.15 with the 1090. All we're doing is reducing expenses. Same company, same product, same everything. So we can go as far down as we would like. So I think I ran this until age 100, and you're not going to see anything change, right? Here's 100. You'll see that same pattern, just the minimum premium policy pull further and further ahead. Now, what about the guarantees? So before we go to the guarantees, what I do want to say is all the cost breakdown we went through, it is good to be aware of that. But if you say, I just want to know that it's set up properly, like I don't need all of those details, what should I look at? I do want to know what to look at to make sure I'm not falling into a trap, or I would have asked the right questions before I started. What we want to look at, simple as this, net cash value. With all things being equal, the same dollar amounts going in. Let's look at the guarantees. Okay. So, exact same thing here. We pulled from the illustrations as well. Here we go. What do we got? Guarantees. Break even between years 8 and 9. That's with a 1090. How about 3070? When is it? Between years 10 and 11. Similar pattern to the non-guarantees. How about that 60-40? When we look at this guy, you paid in 700 between years 13 and 14. Now we can scroll down here, but I'll give you a quick tip actually. This is pretty cool. If you're trying to figure out which example or which product will have more long-term, when we look just at the guarantees, what you'll notice is the death benefit does not appreciate unless you're adding PUAs. If you're not paying anything in or paying just the base premium, the guaranteed death benefit will not increase. So at age 100, the cash value and death benefit will become equal with each other with a whole life insurance policy. Sometimes it's 121 depending on the product. But here it's age 100. The policy that has the highest guaranteed death benefit in this example, in year 8, when we go reduced paid up, will have the most money long term, which makes life easy here, right? So you've got 1.791, 1.710, and 1.583. Let's scroll down here, and what do we notice at age 100? There we go. Close enough at 99. Values are equal with each other across the board. And again, this is based on the guarantees. We can go back to the non-guarantees if we want to look at that. But now we get to see a clean comparison with all things equal, different, same company, same product, same individual, which is always good to look at. We do like to look at too, if you request it and if you're working with us, different splits with different companies, really to get true transparency, just to make sure things are set up properly. I always like to recommend looking at different splits with the same company, product, dividend crediting rate, all things being equal, or just the guarantee. So you've got full transparency from the get-go, because companies do have different ways of applying dividends. Different products have different ways of applying dividends. So it is important to really make sure we have the best option. But when we're doing comparisons, start with a true apples to apples comparison. And then this way, when I start to branch out and compare different companies and products, I can do that and have a concrete answer and not find out after the fact, oh man, I didn't know that. Hope you enjoyed this video. If you did, please hit the like button. Feel free to leave any questions or comments below. I do monitor those and can certainly will attempt to reply back promptly. But as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.